Welcome to another live webinar with us from Full Futures. My name is Sri and I'm your facilitator of the day. Today we will be discussing impact to US markets when the Fed does a rate hike. As you know, since the beginning of this year, the Fed has been inconsistent on the stance between inflation and interest rate hikes. In this webinar, let professional trader who's in the studio with us, Wong Kon, guide you on how to preempt an upcoming rate hike and share what is the possible impact to the US share CFD markets. Mr. Wong, as you know, is a highly experienced professional trader. He has over 25 years of experience in the markets. Just give me a second. Yes, Mr. Wong Kon has more than 25 years of trading experience and being in the financial industry. He is currently an investment strategist, currently managing his own fund, and is the founder for Weipedia Private Limited. That is his company. Kon regularly works with exchanges like CME Group and the Singapore Exchange to both create and deliver training courses. All right, Kon if I see you on the webcam, it looks like you're all set to go. Let me give you sharing rights so we can see your screen. Before Kon starts his webinar proper, can I just do a sound check? Can you hear me loud and clear? If you can, please head on down to the question box, which is located somewhere towards the bottom of your control panel, and type yes, please. All right, thank you, Louis. Can the rest hear me? Can you find your question box? It's on your control panel, somewhere at the bottom. All right, thank you for the confirmation. At any point in time during the webinar, if you have questions, please do feel free to type them into the same question box, okay? And Kon will pick them up towards the end of the webinar, and he will address them. All right, thank you, Ken and Louis. Kon if you're all set to go, I will hand the reins over to you.
All right, so thank you, Sri, once again for this wonderful introduction. And of course, I want to thank you for the rest for tuning in today at this hour at 7 p.m. Yeah, so today I'm going to discuss about the impact to the US market when the Fed does a rate hike. Now, the question is about whether do you think that the rate hike will come or not? And my personal conviction is that the rate hike will come. I'm not too sure if it's going to by this year, but I guess the more important question is not whether it'll come, because more of like the subsequent rate hike, how fast and how rapid it will be, and that will determine the volatility and the direction of the not just the US market but the global market, because the US is still the main driver behind all the capital markets. So we're going to discuss that. I think it's a very short 1 hour presentation, including Q&A. We may stretch a little bit longer if I receive good question from you, or rather if I receive question from you, I'll just do my best to answer all the questions possible. Okay, so I'm just going to move on to the next slide. If you can hear me, that'd be great. I think Sri have spoken quite a bit about myself. Maybe I just narrow down to my expertise. Yeah, I work for, I was once a floor trader before, and I think that has given me an opportunity to really learn and to study the pulse of the market, the greed, the fear, the anger, the confidence of all these traders on the floor itself. So today, of course, how we trade is all through computer matching system. We not able to feel and see and get a sense of all this emotion, but definitely all this emotion is still there, but it's just instead on the trading floor, it is on the screen. But it has given me a privilege to really to study and to understand what is all this emotion all about. So definitely, if you could join me, knowing all this market psychology, or the more scientific term is called behavior science, it will really give you a greater price entry in all your investment and trading. So today I'm just also going to share a little bit about that as well. I think because of this insight that I have over the last few years, my company also start providing expert witness and opinion writing service to assist lawyer in their arbitration for trading dispute as well. So that's something interesting that things have spin off for me and my company. Okay, just want to move on to tonight's topic that disclaimer is important. So I'm very thankful once again for Phillip Futures to invite me to address and discuss about this topic. So I hope that during the Q&A we can have your active participation. So in fact, before we open up for Q&A towards the end, you can start to submit your question, and Sri will moderate the question, and we can have a good time together towards the end of the session. So now, during the session, my presentation, I'm going to share a lot about insight about US dollars, about the treasury bills or bonds or notes, and also what will lead to the interest rate hike. And if the interest rate is going to be gradually or very steeply hiked, how will that impact the market, and how can you manage? So I'm going to squeeze in all this topic to this 1 hour or plus presentation, but it's not going to be hurried, but it's going to be step by step. I hope that you will enjoy it, and eyes will be open. Now, so as I deliver the topic tonight, what I have to let you know here is that whatever I discover or my study is based on my personal conviction, and definitely I will carry out according to what I see and what I understand. But if somewhat you are influenced by my thoughts, my ideas, that you want to, because of me, my presentation, that you want to also get into action, so please consult your financial broker, who is in this case Phillip Futures and Phillip CFD, for their advice, because they have the license to do that. Okay, so I just want to give you a framework of what I will be discussing tonight. Quite a bit of stuff, right? Now, the first part, I'm going to talk about the feather. My conviction, I say that I understand the hike will come, but it's not about whether the hike will come or not. It will come. That's my conviction. Rather, after they started to do a rate hike, I'm more concerned about the subsequent rate hike. Were it going to be gradual, or were it going to be steep? And that is important because that will determine the volatility, the strength of the volatility, and it also determine the direction of not just the US market, but US market, as I said earlier, is still the global leader in the capital market. It will also impact the rest of the stock market as well. So then later on, based on that conviction, we're going to discuss about how I have prepared myself to navigate through this volatility and possible rate hike. So I'm going to share with you some ideas that I have. I hope that will be useful. And towards the end, of course, I'll be happy to receive your Q&A. And I will do my best. I will not know everything. Whatever I know, I will share with you. But if things that I do not understand, I will just be very frank to you that it's not my topic. Sorry, I do not understand. But it's good because during all this Q&A, that's how something that I don't understand, I like to dig in. So that's what also part of being an educator all about. So we are always learning. And I hope this is the same to you as well. Continue to learn, no matter how old and how seasoned or how experienced you are, because the market is always ever changing. Okay, let's discuss about this topic, about the US interest rate. Will Fed ultimately hike the interest rate? So I'm going to go through step by step to let you understand. I'm going to talk about the US debt first. Then after that, I'm going to talk about the US dollars. Then how will US dollars create inflationary pressure? So as the Fed will have no choice but may have to hike the interest rate. So I'm just going to go step by step. So as things start to unfold, as you start to follow in the next few weeks, next few months, or it may take some years to develop, so you have a good footprint what to follow. Okay. Now, so I just want to share with you this very interesting slide here that you can see is about 200 years old chart, right? So you could see that I believe in cycle. I have another chart is about how many hundred? Yeah, about more than 200 years old chart on interest rate. But I think this one there's more clarity. But it's so interesting that I believe in the cycle. In fact, the other chart that I have, you also see cycle as well. So you could see that from 1900 to 1940, before the World War, there are this interest rate cycle. Now this is US interest rate. You could see up for 20 years, then the US interest rates were down before the World War started, or at the end of World War II. Now, so after World War, interest rate was at the low, as you could see. There was a 40 years of trending up for interest rate, and it peaked in 1982. That's US interest rate. So if US interest rate peaked, the rest of the countries, the interest rate will also somewhat peak. Okay, so that's how it works. Now, so it peaked in 1982 and it went all the way down to today. Okay, so in fact, since about 2012, it has been stagnated and stayed in this low for the longest time. Okay, never in history we have such a low interest rate. But you have to understand this, that interest rate moves in cycle. So since it's 40 years up, 40 years down, and when year 2021, right smack of this 40-year cycle. In fact, a little bit on a borrowed time, but you can feel that there's a lot of pressure for that inflation is picking up. And I do believe that the Fed will have to hike interest rate. It's a matter of time. Okay, so like what I say, it's not whether they will hike or not. My conviction is that they have to hike. So later I explain to you why. But more importantly, as an investor and trader yourself and myself, I hope to also share with you my experience here is that as things develop, whatever I share today, you're able to see the footprint. So I think the organizer will have recording to this. You can always revisit this delivery again and again and again. I think it's going to be so classic. Maybe it'll be so applicable in 2 years time, 3 years time. I do not know, but maybe in a few weeks time. I do not know. Okay, so but the concept is there, the foundation is there, the whole structure is there for you to see, look at the footprint. Now, let me ask you the question. Maybe the time is very short. Let me just reply you because I've been conducting this similar sort of topic for numerous occasions. So in different classes, different webinar, I asked the participant about this question about bonds and dollars. But more importantly, the next question is that who is the largest investor in the US Treasury securities or the US Treasury bonds or the US debt? Now, who is the largest investor? Like what I say, I've been delivering this topic in numerous classes and all of them give me a consistent answer. I will suspect that this class will be no exception. You may say that maybe 80% of you guys that tune in will say that China is the largest investor of the US debt. Yes, it's right. That was in the past. Okay, but today, who is the largest investor in the US debt is no longer China. China has fallen to position number 3. Now, let me just give you an understanding here. I didn't quite update it as of April, but as of June 2021, you can see that who is the largest investor of the US debt today. It is the US Federal or the US Federal or the central bank. That central bank are the one that printed money and invest and buy into the US government bonds so that to build the infrastructure, so on and so forth. So back in 2008, China was number 1, 2010 about there. But after 2010 and onwards, where QE 1, 2, and 3 started, Federal themselves, the Central Bank of the United States, has become the number 1 investor of their US Treasury debt. Okay, so Japan today is about number 2, and China has fallen to number 3 in position, and UK at 443 billion US dollars. So it's related to US dollars. Later I explain to you how it works. Okay, so that was in 2008. I marked there. It was an event where we all witnessed, or you may have read about it, that Wall Street meltdown followed by Lehman crisis, and then US was really desperate about it. In fact, George Bush, then the president of the United States, called out China. Then the chairman was Hu Jintao, to ask them to continuously support to invest in their bonds. And then the Chinese president agreed to it. They are in full support of US that say, rest assured, we will continue to invest in the bonds. That was the relationship between China and US back then. US consume, China manufacture, then Chinese make the money, but it's a kind of a agreement where the Chinese earn the US dollars, they will reinvest back to the US bonds. So it keep the whole cycle going, which is a wonderful thing. Yeah. So, but because of the last crisis, the last cycle, that was in 2008, was so deep, the Fed did something that's very unusual, that for the first time in history, they have became the largest investor of their US Treasury debt. So before that they do, but not in such a scale. But with QE1, QE2, QE3, you could see that in this chart. Now, this chart, it represents the holding of the US Federal Central Bank of the US Treasury security. Now, let me just repeat. This chart is not about China or Japan or UK. This chart is the portfolio, the holding portfolio of the Central Bank of the United States, which is a federal, the holding of the US Treasury security. Now, it's a very complex thing. So that's why I put a footnote there. You can read about it. It's not a direct purchase, but somehow each time they produce a QE1, QE2, QE3, you could see that the exposure increase. So it's kind of related as well. So, but you have to understand that now all these are not shy to talk about it. It's basically very plain vanilla. Is how Fed have done it, is that they just print money and then they invest in their US Treasury debt. So there's nothing to be shy about, not to discuss about this today. Yeah. So back then it's a bit reserved, because I'm market practitioner. I got to be very careful. But now it's a kind of a known fact, right? So now then you can see that the portfolio increases when the pandemic started in 2020 in January. That was last year, and then it hit US somewhere in late February and March, and then Trump. So Trump have this Trump Cares Act. So basically, again, the whole cycle continues. Yeah, the whole trend of money printing continues. Basically, the Fed, the Congress agree that they print money, and then they create some liquidity in the market. That was on Trump, called the Trump Cares Act. It was 2.2 trillion US dollars. Then Biden this year in 11 March also have Biden American Rescue Plan, which cost them 1.9 trillion US dollars, means that they print and they invest in all these different things. So basically the whole thing about this chart, it represents that how much money I printed. Okay, so a lot. So you'd be surprised to see that, oh, so Fed is the largest investor in the US bonds today. Now, the question about this Fed printed money to invest in bonds, what would that lead to? That's the key thing. Okay, now, so basically whatever they're printed is US dollars. Now, the concept is that I hope that I have time to elaborate further the relationship between US dollars, the printed US dollars, and the weakness of the US dollars that will cause inflation. But tonight, I'm not going to cover about this topic because I need an hour to do that. So, but you just have to understand the concept here is that the more money that US printed, it's just going to debase the US dollars. You're just going to make the US dollars more diluted instead of more saturated. The more money you print, you're just going to make your US dollars more diluted. Dilution of currency means that your currency will be weaker. Weaker, it means that you, with much more US dollars today, you can buy this much. But in the past, with this little of US dollars, you can buy much more. Yeah, the same thing. The same assets. Today, you have to spend so much more to buy the same assets. That's what I mean, or the same piece of bread. Now, so let's look at the US dollars in that relationship that I reckon that as these things continue. Now, I have this, if you ask me about, Konhao, what do you think about the US stock market direction? I think likely it will still continue to go up. Okay, provided the interest rate is not going to hike very steeply. So in a short while, I'll discuss about it, what they mean by they provided the interest rate is not going to hike too steeply. Now, as more money is printed, like what I say, there will be dilution in US dollars. When there's dilution in US dollars, things will get inflated. Now, let's look at this concept here that you can see since 1983, that's where Ronald Reagan started expanding the US economy, more money being printed than ever before. That you could see that the US dollars over this whole span of the last few decades has on the decline. It means that the US dollars has been weakened. Okay, now obviously technical analysis, you could see that's a wedge, and I could see that the US dollars, the market itself trying to support the US dollars at 80 US dollars. This is a US dollars index. So my view is that 80 US dollars became a benchmark that you got to watch it like a hawk. As you could see that the market forces are trying to support the US dollars at 80. So they do not want to let it fall. Since 1988, no, since 1978 until today, 80 US dollars has been supported. But we understand that with the continuous printing of US dollars, the US dollars will be weakened. Now, so just now I got a bit sidetracked. I say that how do I know the direction of the US market is this? As long as US Congress and central bank has the ability to continue this relationship, to issue bonds, to help the industry to expand their economy, as long as that they have the ability and capacity that will not cause a mistrust between the investor and themselves, that they can continue to build on this relationship, I think the US stock market should be okay. Okay, but we got to watch it very carefully about the US dollars and the US interest rate, because listed companies, borrowers on property market, they do not like higher interest rate. It's a death sentence to them. Okay, they do not welcome that. Now, so like what I say, I hope that I can have more time to go into that, but let's understand this concept here is that what do you think the direction of the US dollars in the next few years? Do you think you'll go up to go break this trend, downtrend to trend back to about 110, 120? Or do you think you'll be stay under pressure and likely to retest 80? I would like to think that based on the macro analysis that I've just discussed, likely the US dollars in the near and far future is going to get weaker along the timeline. Okay, so now, so that's what what's the impact of a weaker currency? The impact of weaker currency based on all these products are priced in US dollars. When the US dollars are weakened, commodity price inflated. Now, I want you to take a look at this chart here. This was just about less than 2 years. You could look at the year, it was 2020. That's where the pandemic started, and most of the commodity prices was around the low. But look at it until today. Now, I prepared this slide about 1 month ago, but it's still quite relevant. That you could see that in cattle prices, the red meat that we are taking, and by the way, these are from exchange prices, so these are raw prices. It's not, there's no middleman involved yet. Okay, once a middleman come in, all these commodity prices will get more expensive. These are raw prices, exchange traded prices. Then you can see that the red meat prices over last year, when the pandemic happened, until today, it have appreciated by 54%. Soya bean increased by 1/4. It's so much needed. These are all basic essential food. If you open up your fridge, you'll see soybean product everywhere. Iron is so much needed for our production. It has increased about 1.3-folds. And so is corn, increased by about 1.4-folds, or 144%. So I just want to give you this concept is that once the currency is weakened, all these commodities are priced in US dollars. These commodity prices will increase. Why is it increase? Because of the weakness of that base currency, and therefore increase. So there's inflation. Now, maybe in this part of the world, we don't feel that much yet. There's many reasons. It could be one of it is that our currency are still strong, or it could be the body behind this have hedged or their stockpile. I do not know, but we don't feel it much yet. But I can tell you surely, if you are a citizen of the United States or in the West, you'll feel that the things that you buy is getting more and more expensive. It's about 1.1 times more, 1.5 times more just compared to last year. So is the inflation already here? Yes, the inflation is already here. Is whether the speed of inflation, how it's going to impact the decision for the central bank. So we're going to study that a little bit more. Okay, now, so the next topic will be, so how will a higher interest rate impact the stock market? So it'd be very good that if you are really new to investing and you have this urge that, it's a very human nature that when things are hot, US has been going back by a few folds and China got all this regulation, Singapore market seems boring, that you have this urge to say that US, you want to chase after it. So please don't, because I'm going to explain to you how it works. Okay. So, but I still believe that US market is still in a growth stage. You are still going to continue to go up. Why? Because as long as they can continue to issue all these bills, all this budget, and it's being approved, I think US market should be fine. If you really study through all these, when a Congress approve all these bills, they can spend money each time they approve or each time a president suggested, the stock market go up. So as long as they can do that, I think the stock market should be okay. But it's on a very shaky ground, so you have to be very careful not to be too passive. So later I explain to you on the investment and trading strategy part. So now, how will a higher interest rate impact the stock market? Let's study about this topic here. Now let's go back to this 1982. There you can see the peak of interest rate. That was in 1982, and it reached the trough. Trough means that the lowest point in the recent years. Now I want to go back to history to understand about the flip side of interest rate. From the low side, there you can see from 1940, it was remained low to about 1967. If you look at a trend line just drawn, that was in 1967. In fact, 1940 reached the trough, and then it kind of moved up. Now, my topic is about I've no question that the Fed will hike interest rate. They will hike, okay? But a question of how much they hike. So let me just go back in time. We study about history, so you understand that if they hike too much, too quick, too much, how would that impact the market? Let's go back in history to study about 1967. So from 1940 to before 1967, they have already gradually hiked the rate. But once it crossed 1967, you could see that the rate hike has steepened quite a bit, right? I think you could see that. Now, let me just draw you a little bit closer, give you a more micro view, okay? Now, let's look at 1967. In fact, from 1940, the interest rate started to move up, but in a very linear pace. But in 1967, just now I draw a very basic trend line. You could see that the interest rate have broken the resistance, and all this, it helps to me. If as an investor, I look at charts, I look at them. It is very useful for me to analyze the market. Now you could see that as I prepare this slide, I overlay this over pink circle, right? And each time they hiked, I got to tilt the gradient a little bit more. So it got steep, it got steeper, it got steeper, and it was quite fun, yeah. So part of my research here is that as I look back in 1967, you would have agreed with me from 1967 and onwards all the way to 1982. And mind you that then the Fed have increased the rate to 20%. If you can see that, it was 20% in 1982, the highest point. And if you are interested to know about how about the Singapore market, did we hike interest rate? Yes, we did hike interest rate. I asked my dad about this, my father about this. How much was his housing loan back then? He told me that it was 14%. So yeah, that was quite scary. So, but anyway, so now you could see that from 1967, the interest rate started to got steep. Yeah, steeper, yeah, all the way to 1982 it peaked. So I want to focus in 1967 and onwards, the interest rate got really steep. Now, what happened to the stock market? So 1962 is fine. The stock market now, this is Dow Jones already, okay? Dow Jones, the market continued to go up. So when the interest rate high, when it's gradual, it's fine. But when it got steep, it means what? It means that the Fed is like between the Fed and Congress, it got a bit haywire. They got to speed things up, because things are getting very, very inflated. So they have to tune up the interest rate tuner a bit more, So there's a lot of stress in the market, and that's no good for the market. And you could see that since 1967, when the interest rate hiked a lot in a short time, look at the stock market, what happened? It peaked in 1967, about there. 1966, it peaked. 1967, that's when the interest rate picked up. And within this period, the stock market, Dow Jones, has collapsed to 2232. Okay. Now I could see that how much did it collapse? about 73%. So I just want to see the relationship on the long-term cycle for interest rate. On the long-term cycle of interest rate is when interest rate begin to pick up, it is not a good news for the capital market, especially those stocks are into high gearing. High gearing means that those companies are into heavily borrowings for the expansion. So just be careful about what you invest in, what you trade in, especially in times like this. Okay, so I would prefer to a bit conservative. If you want to go for long haul, those company invest in will be of those that the gearing are not too high at this point in time, because different period, different cycle, where you have to look at it very differently. Okay, so in times like this, no, I will prefer to go slow and go safe. But I also enjoy trading, so later I'll share with you a little bit about that also. Okay, so how are we going to manage in assuming that the interest rate is on the rise? Okay, it will come. I believe it will come. That's my personal conviction, right? So it will come, but what I just want to give you a context whereby what if it's quite steep? Okay, so how are we going to manage our investment? Maybe in the US market, in Singapore market, or Asia market? How are we going to invest in our stock market? I'm just going to drill into specifically about stock market, but you can try to ask me about, if you have interest in property, you can ask me on that as well. Okay, so we can discuss that later on. So on the assumption of the interest rates on the rise and may get a little bit steeper, how are we going to manage our investing and trading both together? Okay, so we have to understand about this concept. I've coined this concept some years ago. Okay, so now notice what I say here in every growing market. Every growing market means that this unit, this organism, this market is set to grow. Like for example, Singapore, you look at the whole dynamic about Singapore, our government are always constantly growing. They like to grow, they love growth. But some countries or some market or some company, they don't mind not to grow. They just want the way it is. As long as we can continue to generate good GDP, people are well, people are happy, it's okay. We don't always have to pursue growth. Some companies are like that. They just want to pursue for income. So they don't want growth. Okay, so they don't want to take a risk. There are countries like that. There are companies like that. But some companies or country, they pursue for growth. Now, in every growing market, I study there are 3 stages in a growing market. Okay, so I'm going to talk about growing market. So there's the first stage is called the income stage, followed by value stage and growth stage. So later on, I'm going to get deeper into it. I'm going to define each one with the example on Apple shares, the US share, because Sri asked me to talk specifically on the US stock market today. So I'm going to talk about one example using this concept in a growing market, in this growing shares since in the 80s. Okay, so in the 80s, I think we heard about Apple already. Back then it's called Macintosh. Yeah, I was in secondary school, primary school. I saw a Macintosh computer. Yeah, so we know what is Apple. Yeah, so Apple, even then, we know that there's growth in it. It's very dynamic, it's very robust. So there's income, value, and growth stage. Now, before that, let me just explain to you how it works with Dow Jones, the US stock market first. Now, some may have misunderstood that the US market has been going up for the last 100 years. Let me just clarify, US market has not been going up for the last 100 years. If you heard that, I think it's just trying to sell you something. So now US market have not been going up for the last 100 years. Now, if you look at from 1920 all the way to 1980, US stock market, this Dow Jones, and this is not a linear chart, this is a log chart. Log chart means that it kind of chart out in percentage so you can see the final print of the market itself. Now, from 1920 all the way to 1980, you could see that it started at 2005. And 1980, it also closed at 2005. So the market, the whole market for decades has been stagnated. It's only in 1980 and onwards when interest rates start to fall. Can you see the relationship here? The inverse relationship of interest rate and the stock market or capital market. When interest rates start to fall, then the stock market also pick up. So interest rate, it is very crucial. Okay, so they are not separated, they are together like a twins. Okay, so now so where was the income stage back then in US? this is income stage. Means that yeah, it was range, 5,000 point range, up and down. Yeah. So this is value. Now value later on, I'm going to explain to you. I'll use Apple shares and as an example. And today, US market is in a growth stage. So I'm going to explain to you the strategy for the US market in a growth stage today. So in a growth stage, there's also few stages. So if you can identify a growth stage, the best is that you get in at the beginning of the growth, not towards the end of the growth. So growth, there are stages as well. So you've got to be very mindful about that. Now, Apple shares. Now look at Apple shares. Today, where is the income stage? Where was the value stage? And where is the growth stage? Let me just unpack one by one with definition here. Okay, so income stage is this. I will define that the stable companies that have stable dividends. That means you're not too concerned about the market volatility, because you know that capital gain is not my concern, because I like this company stable. Every year I can receive dividend. Now some companies I will still call them as income stage, because although they do not pay dividend, but they are just like that. They will earn money, they'll reinvest the money into the company for R&D because they want into growth stage. But like what I say, in every growing market, I study that it went to 3 stages. Income, the next one will be value. Now value, a lot of them say that value investing is passive, that I buy shares and hold it forever. No, to me, if you have this idea that value investing is passive, I buy and I hold it forever, to me that's classified as income stock. Now value is this. Value, I literally redefine. Okay, like what I said, all these I call it myself. Now value I redefine as that they are the companies that are trading significantly below its fair value today. Now, the second part is important as it is entering into its growth stage. That means it's at the bottleneck point. It's about to enter the growth stage. Maybe they'll be successful, maybe they're not. Okay, so you have to look at it. It was in 2006. Yeah, 2006. Apple always had failed to cross about above $2.50. But for the first time in history, Apple have crossed above $2.50, and there was a sudden surge. So you have to believe with me when we talk about market psychology or behavior science, there is a reason why market surge. There must be a reason. Okay, so look out for this kind of opportunity where I really enjoy, because that as is entering the growth stage, it means that you may be getting into at the beginning stage of the growth stage. Now, as the market grow, so what happened? As the market grow, this is called the growth stage. How you identify growth stage actually is very simple. Now, I define this as the company that is already trending. Now, so most of the US blue chip are already in the growth stage, and with strong earnings and strong growth prospect. So like earlier, I say that in growth stage, you also identify that where are we today? Are we at the beginning of the growth? Are we in the maturity of the growth? Or are we at the euphoric of the growth? So all these are different stages of a growth company. Now, today, Dow Jones this month have breached about 35,000. Okay, this month is August. So in July, it breached about 35,000. So now my question to you is this: if you're new, or even you're quite experienced investor, but you're tempted to buy into US stocks and hold it for long term. Say for example, now what did I say here? I say that if we were to start investing here today, start your investment here today, can we afford to be a passive investor? So earlier I defined passive investor, most of them say value investor. That means that the idea, and I want to hold it forever. I don't have to care on how, because over the last 100 years, the US market has been going up, always been going up. So it doesn't matter if the market have dropped a little bit, it will sure bounce back. And that really concern me, So you have to understand the stages. You have to understand about interest rate. So do not get sucked into all these sales stocks. So we have to invest with wisdom. Okay, so you can do it. Okay, you can do it. So now, if you are going to be new in investing, Can we afford to be a passive investor? Of course, my answer is no. Okay, we try to be a bit more vigilant, knowing that where the risk is in the growth. Obviously, this U.S. market is in a growth stage, but to me, it's at the last few stages. It may still continue to grow, so I tend to position myself to trade the U.S. market. I prefer to be a little bit more active. Active means that I will swing it around. Means that each time when it dip, I'll look for opportunity to buy. But because I say that my sense is that as long as the Congress have the ability and trust to continue to issue new bills, new infrastructure plan or whatever, and the stock market should be okay. So each time there's a dip, I will view it as opportunity where to buy. But when it swing up, I will try to catch up. That means I try not to be too passive. I try not to be, I don't care, I don't want to know, because it's a good stock. So especially for US market, I have to be more vigilant. Okay, so that's my advice to you. Okay, so where is the market to look at? Okay, so November 10, 2020. Yeah, so that was last year, November. I was invited to also speak in Hong Kong at the comfort of my home. Back then with pandemic, right? So now what happened here is that Hong Kong, one of the leading broker, they observe that now this is a program I did for them, is free. You can view it after the program tonight if you have time, or this weekend. Although I presented it last year, November, but it's still applicable today because I'm talking about the Singapore market direction for the next few decades. Okay, so that means I'm investing into my next generation, what to invest into my next generation. Now, so one of the leading broker in Hong Kong called me up. They say that, that was last year, say, hey, Kon Hao, in July 2020, we observed something here in Hong Kong, is that we observed that a lot of institutional fund around the world has been start to acquire Singapore shares through Hong Kong. Okay, so that means through Hong Kong, their brokers, they start to invest in Singapore shares. They saw that a lot of institutional investors around the world through Hong Kong or directly to Singapore has been investing in Singapore shares. They asked me, do you know the reason why? Can you present to us a topic about that? I say, sure. I think I know, because I'm also very interested in Singapore as well because of the pandemic. Now, so the topic was a lion that roars in a time of uncertainty, Singapore. Okay, now you can scan this or watch it after this event, not now, okay? So, or over the weekend. So I think you're gonna enjoy it. So at least you have your idea about why Singapore is still at the income stage, and I hope that we can enter into a value stage. Okay, so China, if you're keen in China, I felt that China has really entered into the value stage. Maybe it is at the beginning of a growth stage. So I like China a lot. So about 5 years ago, I've been going to different environments, talk about long-term investment about China. So some of them already go by few folds. Now, so this was on November the 10th, 2020. That was last year, right? So I spoke to in Hong Kong to about 30 countries, institutional investor, to about 300 participants. So I say, look at Singapore. It is time that maybe it's at the trough. Look at that. Okay, so you have time, go through that 1 hour presentation. I think you'll be blessed. So shortly later, the market recent high was on the 30th April. It reached 3,237. Okay, so just in case you miss it, just go and view it. Now, so what's my point here? My point is this. Okay, so November 10, 2020, I believe that Singapore is this. Now, as an investor, we have to have some foresight. We need to be a visionary. We need to look at the macro. Now, I believe that Singapore over the last 2 decades has been as an income stage. A lot of them say Singapore is very boring. Not exactly, okay? Not exactly. But now I'm going to project the next 10, 20, or 30 years ahead. I will still be alive, okay? So, but more for my inheritance, that I want to pass this to my children. So I felt that we're still at income stage, and I hope that because of the pandemic, we're able to enter into the value stage. And on the ground, I think it's already happening. So watch the video, you know why. Okay, so I suspect that in the next few decades to come, Asia will be very different, especially Singapore and somewhere further north as well. Okay, so I suspect we're going to enter into a value stage. In fact, I think fundamentally on the ground, a lot of companies, especially in the high tech, where have already entered into a value stage. It's just the beginning of growth stage, but it's just that all these companies have not been in listed here in Singapore yet, not yet. Okay, so that's my point. I just want to give you a different dynamic about US market, about Asia market. Then after that, we're going to move into this subject here where Phillip Futures supported this program. Okay, so I have this program. The program is called Timing the Market, Invest and Trade Precision. So Phillip Futures CFD would like to sponsor part of this program, which I think they've been looking around for a course content that their client will be blessed. So allow me to read into Phillip Futures if Sri, you may allow me to do that, because I use the word with Phillip Futures as well, which I enjoy the culture a lot. So they want their client to have a longevity, means that don't just come in and maybe have lost some money. 90% of investors and traders will ultimately lose money, but don't just do that. But even you lost some money is fine, but make sure we learn why we lost money. We need to create a longevity. As a lifelong career, investment is part of the game. You know, even you're not in this field, but once you retire or even before retire, get serious about investment, because the second half of your life, most of us, I believe up to about 70% of us, will invest with our money. So it's like a career to me for many of us here. So now this course, Timing the Market, so basically we're going to read into income, value, and growth stage. So what is the precision timing? How to read into all these and exactly when to enter. So we're going to study into the price behavior. So what you can do is that you can do a QR code scan. Now this program is started with, I first started, the price was 135 US dollars, but over the years or month, I have increased to about 265 US dollars, because along the way, our add in new content. So as new content is added, the price just go up. So same here, if you purchase today at 265 US dollars, along the timeline, I'll add new content, but you don't have to pay extra anymore. Okay, so that's the best part about it. So I hardly give discount, but because of this arrangement, Philip encouraged me to give a coupon discount, so which I did. So it's a 20% off, which is 265 US dollars, 20% off, that will be 212 US dollars. So the discount code is today's date, and as you can see there, and there's a time to this, so it's a time sales, so to speak. It's up to tomorrow 10 p.m. So if you can study through the curriculum, I'm sure you'll bless you. You'll know how to identify what's income, value, and growth, and exactly what's the precision entry, because I'm going to talk about the precision entry on each stage. So yeah, okay, allow me to just go through very quickly on the content. I know that you can do a QR code scan, you can read into the content detail. There's a video I did about 6 minutes about the content, what is it all about. But let me just go through very quickly here. It's not all, but I kind of summarize it. So basically, the whole content is that we're going to study into prices. We're going to understand about income, value, and growth, and how to get into the market specifically, because that's what we know. I always focus on precision entry. So we're going to study into one price or a series of prices. So sometimes the price will happen one particular period or one particular month or week, but sometimes it may take a few weeks to show to us. So I'm going to discuss that, how to read into it. And all this market is not done without volume, because volume is important. So we may, after studying the price, if we find something interesting, we will also have to study into the volume. It could be one volume or a few periods of volume. So we're going to study into that, very interesting. So now between the price and the volume, once there's something concrete, we have to form an opinion. I'll share with you how to enter to the market specifically. Okay, so we're going to talk about entry. Now, after we enter into our market, that's not all. We still have to manage it, right? What if the market whipsaw? Whipsaw means that it starts to move north and south. How are you going to manage it? So we're going to talk about how to manage your position when the market whipsaw. Now, something I like about this program, I think Philip, you just like it also. That's why they wanted me to, they have endorsed this program. They asked me, they want a good program so that their client be blessed. They have a certain continuity. They want their client to learn, keep on learning. So now, how do I create this keep on learning? Not just because of this arrangement. All this while, I wanted my followers to keep learning. Okay, so what I did is that After you learn through this content, every week I will, in this chat group that I have, those who subscribe to this program, I will share one case study. Yeah, one case study. If you go through this program, you should be able to identify. If you cannot identify the opportunity, it is okay. Give yourself some time. The more case study you see, I hope through this arrangement, the more sharper, the more experience you get. So give yourself some time. It could take months, I hope not years. Then there'll be a form of discussion between the members as well. So it's quite fun. I really enjoyed. So I just posted one on the China market yesterday, okay, China textile. So then you can refer back to some of the past case study also. But that's not all. Now, so after you learn all these, every week I'll release one tab about the precision entry on income stocks. So after that, rest for 1 week, you go back to the content itself. Now, all these are I would say free access. These are, once you subscribe to it, you'll be yours perpetually. Then every week I will give you one case study. You can choose to participate or you can choose to stop. Most of them choose to stop because they're quite shy to talk about it. They don't want to, yeah, you know, Asian, okay? So 1 week later, I'll go into the precision investing about value stock investor. Now, why I do that? Because I know that if I release everything to you, the first few things you'll go is these few, okay? But I want to build the fundamental correct first. Then before each week, I release one tab on precision investing into growth stock. Then finally on precision entry, even for traders, it works for traders as well. Because once you understand this concept, we just basically study the price behavior of all the market. Now, let me just give you one example here. If you're traders, of course, you look at index, which is also in Philip CFD is available as well. You look at a short time frame, say about 15 minutes, if you're a trader. That means you trade a little bit much more shorter term. Now, there's also a period, if you can see, there's also an income period, value period, and also growth period. So once you're able to understand this structure and look at the breakout, value is actually breakout. So during the content itself, I give you another set of definition for traders. It's similar, but it's not the current definition. So you will love it, okay, if you're a trader. So you're able to find that between traders and investor, we look at time frame, the different time frame, but the concept is the same. Then you may ask me, why is it so fascinating? The reason is very simple. Because all these markets are traded by human. So human, we all have emotion. So basically the whole concept of studying to all these to create a precision entry is that we study into the market psychology of human. The greed, the fear, the insiders trading, it is always there. Okay. So before I enter the Q&A, I just want to flash this code here. So it will expire, the discount code for 20% will be expired tomorrow at 10 p.m. The discount code is, as you can see on the screen, 03AUG21. Philip Futures only give out about 30. Later on, Sri is going to mention about, before I go into Q&A, Sri is going to mention about Philip want to subsidize further. Okay, so there's only 30 tickets to subsidize on this. So if the 30 tickets have all been taken up, but you still want that 20% discount, you just type 04AUG21. Also up to tomorrow at 10 p.m. So of course, if you find that your friend will be blessed by this program, you can always give them the discount code to them as well. So maybe I just invite, before I go to Q&A, I just invite Sri to tell the audience tonight about so how Philip is going to subsidize further on this program on top of the 20% discount. Yeah.
Thank you so much, Konhao. Well, when you trade with Philip Futures, it's a gift that keeps on giving. Well, what do I mean? When you sign up for Konhao's trading workshop and learn how to trade with greater accuracy, you will also get $100 in rebate when you open an account and trade with Philip Futures. Let me just show you my slide. Yes, so the QR code to open an account very quickly and easily in minutes online is via using that QR code. So you open an account, deposit at least 1,000 SGD or equivalent, sign up for Konhao's workshop, and be a better and more effective trader, and you will receive a $100 rebate within 1 month. So that's 20% off Konhao's workshop and an extra $100 rebate when you open an account and trade with Full Futures and apply the techniques that you have learned from Conhal's workshop. Okay, I'll leave this QR code on the screen for a moment. Dear audience, now's the right time for you to type your questions for Conhal into the question box. He will address them, and you can get your queries about the market addressed, as well as anything else that you've noticed in the market. Conhal will be the right person to address them. All right, so head on down to your question box, and we will look forward to your questions.
Okay, before we receive all these questions, and Sri will moderate the question, just to let you know that although I'm a long-term investor, but also look at derivative like CFD. I just received a question on the chat box yesterday. Very interesting here is that one of the party that asked me that CFD platform that he's trading with, he just felt that they trigger his stocks, that they read into the stock and trigger the stops. Then I told him that I do not know which CFD traders or platform that you're using. So it's important that you use a reputable one. So as far as I know, my contacts in Singapore contacts, the CFD platform is that if you're going to read into your client's stop loss and you take advantage of all these, to me, is not legal. So I do not think so. So therefore, it's important to look for a reputable CFD platform. And in terms of volatility, in times of bearishness may come. So it's even more important to engage in some sort of derivative as a hedge, or when it start to move south. So my growth concept early you saw is that I'll basically on US markets, very simple concept is that I'll look for dip to buy into the US stock. But what if the whole thing flip around? It became a downtrend. So then the concept will reverse and look for our sell on strength. So that one I will discuss in the course as well. So then how you sell on strength, how to take advantage of it, then all this CFD platform became quite useful. Okay. So yeah, so again, the $1,000 deposit is just a deposit, is not going to be taken away from you. Why I know that? Because last time I was a broker before, and now I'm no longer a broker. So 1,000 is deposit. If you find that after you subscribe to the course, there's this 20% discount and also this $100 rebate. But if you find that it's not suitable, you can always withdraw the fund out. Okay, 1,000 plus the $100. Yeah, so just give yourself to try the platform. Okay, so Sri, do you have some question that we received tonight?
Yes, just as you mentioned that, we have a question in the question box. Well, okay. With this is from Kit. Kit is asking, with cryptocurrencies becoming a likely viable medium of exchange, how exposed are they to inflation? Are their mining akin to money printing by the Fed?
Okay, for cryptocurrency, I'm still watching. So if you ask me about cryptocurrency, I do not invest in them. I enjoy trading them because cryptocurrency, the volatility is fantastic. Why I do not invest in cryptocurrency is because cryptocurrency at this point in time, its intrinsic value cannot be calculated. So as long as cryptocurrency intrinsic value cannot be calculated, there's no investment value to me. Okay, so yeah, so sorry to say from those who enjoy cryptocurrency, but that's my opinion that I do not invest in cryptocurrency. And I think it's a separate market. Why? Because what we should be looking out for right now is that is the digital currency. How will digital currency take shape? Now, cryptocurrency are in a way birthed off by the private enterprise anywhere, right? But digital currency are birthed off by the central bank. So I'm be very interested to observe but digital currency also have blockchain technology within. But how will it be successful in the digital currency? Who is taking the lead right now? China is taking the lead. How successful they are, If they're successful, will that replace cryptocurrency? I have no answer, but everything when it comes to this digital and cryptocurrency, they're very new, but they're two separate things. I'm more interested, if you ask me, I'm more interested into digital currency. And no, I do not think it's a form of money printing, because at the moment, the digital currency, you have to study very clearly who is a central bank that is taking the lead right now. Okay, so once you understand, you also may have agreed with me that it's not a form of printing money, not at this point in time. Okay.
All right, very good question from Kit. Richard is asking, is the $100 rebate, does it apply to existing Flip Futures customer? If you're already a customer, great. Let us know your interest in the survey form after the webinar, and we'll get in touch with you after the webinar. All right, most likely tomorrow, post-webinar, when we do a follow-up, we'll get in touch with you. Next question is from Kaifan. All right, Kon Hao, what are your thoughts on Chinese tech?
Chinese tech. Okay. Now, if you can go to the website, let me just share with you this website, the next few slides I have.
Let me give you sharing rights, Kon Hao. One second.
Okay. Now, go to this free resources, my website, weipedia.com, about Chinese company. Right? You go to look for thoughts and you type China. I written a blog in 2016 about China. Back then, I recognized that China was at its value stage in 2016, in June 2016. That was 5 years ago. And that was my first time I started investing in China. Then today, some of the fund, depending on different fund, but just strictly on A50 index means that the Shanghai blue chip 50 index, the fund has appreciated by about 2.5 times. So some fund is even more. Now, so about the Chinese tech is very straightforward. To me, that China, if you hear me quite clearly earlier, is that I felt that the Chinese market from value stage has just entered into a growth stage. And the growth stage is at the beginning of the growth. So remember the STI chart, but if you look at the Chinese chart, you compact it, I think there's still a lot of runway. Let me just give you some idea here is this. Now, in Asia, Singapore and Hong Kong stock market, we are one of the oldest in Asia. We started in the 80s, Singapore and Hong Kong. Now, for Chinese market, the capital market only started in the 90s. The Chinese stock market only started in the 90s. Now, can you see the history is so short, but between 90s to today, you look at the tech companies, is physical, is tangible, and it's taking many nations by storm. So to me, is the history are short, just at the beginning. And let me just give you some understanding about all this tech bubble that's the China regulator, they are clamping down on education, on tech, on property. Okay, I think it's a very good thing. What they're trying to do here is that they do not want the private entities to monopolize, because they study the US market. They do not want another Facebook or Google that they're monopolizing. They have a lot of data privacy issue, but China do not want that. For example, last week or 2 weeks ago, they clamped down on education. So what did they clamp down on? It was because of they said this, okay? They do not want their core subject, their tuition core subject. Now, tuition in China is a very big thing because of Asia culture. They make a lot of money, the education provider. Now, so of course, they tax on the parents on those core subjects, math, science, Chinese, so on and so forth. Right? So all these are core subjects. So the Chinese regulators come in and say that as long as academic core subject, you cannot profit from it. It means that, yes, you can profit from other subjects like music, business English, you can profit, but when it comes to core subject, tuition center, you cannot profit from it. So I felt that is a very good thing. It brought forth social, it brings up social pressure, especially if your parents, you know what I mean. So I felt it's a good thing. So it's the tech about the DD, the driver, all this and that, made one. It's all about, it was saying that they want their driver to be fairly being paid. there must be a minimum wage because the driver overworked, that the delivery time must be spread out. So to me, it's about workers' benefit. So if you look at the long term, it's not a bad thing. Now, in part of this growth, whenever the regulators start to clamp down on all these, it will cause a knee-jerk reaction. So to me, this deep in part of the long-term growth is, to me, is a buying opportunity. So by the way, me and my wife, we just opened a joint account in Phillip. So we are getting ready to enter the market with our joint fund also. Okay, so just to give you some clue. So you talk about the recent tech clamp down. So that's my take. The growth, in my opinion, the growth has already begun, but all these little meltdown to me is a good thing, that I will take all these as an opportunity to buy. So within that course, you'll learn about all these. During the chat, you can say that we're going to start about price behavior, but within the, when I present you a case study, or you can, after a while, you get quite expert into reading for opportunity. I will also welcome that you include your chart and share it to the group, then allow me to make correction as well. Then within that, I'll also share with you my macro view. We can share about our macro view as well. I think there'll be a lot of fun. But within the content, I'm going to talk about very step-by-step systematic how to understand about price, behavior, volume, and how to look for an entry price, whether in a income stage, value stage, or growth stage. So very specific on that. So, So about this slides, right? You go to the free resources, can find my blog in 2016. Then I have this Facebook page. Every day I'll post, I enjoy reading. So every day I'll post an insight of whatever I read. So please like and follow my Facebook page. My Facebook page is Kon Hao, my name joined together. So like or follow. So when I post my thoughts, or an opportunity or article I read, I summarize it. You will be notified. Okay, so please like it if you can. And this is my YouTube and Instagram. And any question, even after tonight, or even if you don't subscribe to the program, it's fine. You can always email to me. Okay, but I'm quite confident that you'll be blessed by the program. Okay, it's not a lifelong thing. It's considered lifelong, because once you subscribe to it, you can access to it 24/7, and you will be part of this chat group 24/7. Okay. So maybe I take on the last question. We have time is running out for us.
Yes, we have one last question from Morris. Morris is asking, what are some things to look out for in the upcoming Jackson Hole Symposium? What are your thoughts, Kon Hao?
Honestly, like what I say, if I have no thoughts, I just tell you that there's no thoughts, because I think my key concern here is that I still look at what I do, all these events, we just let it unfold. Okay, something about investment and trading is this: try not to anticipate. If you find that Jackson Hole event is meaningful, let it happen, and you see, is there any reaction to it? Okay, so once a reaction is done, then you make a decision. If the reaction is more on the negative side, you will bring down the market, but it may be also an opportunity where you bring down the market, it created an undervalued situation. So that's after the event. If there's some negative impact to that event, whatever is being said, then the market went all the way down because it created an undervalued situation after the event. Then you find that there's opportunity that you get into it. So what I'm more concerned here is that whatever I do is that I try not to anticipate if there's an event or there's a meeting, because nobody knows what will be the outcome. Usually what I do is that you got to know all these, what's the expectation, all this and that, but let the event happen, let the outcome being said and done first. So when the outcome being said and done, look at the market reaction. Okay, now usually the market are wrong. So whatever the market react, it will either brought forth overvalued situation or undervalued situation. Then that's where the opportunity is. Now moving forward, just to end off with here, what am I looking at week after week? Few things: the dollar, of course, all the major indices, the US dollars, the T-bonds, the treasury bonds is important. Look for the bonds, the yields. So these are the few things: US dollars, the bonds, the yields. The yields are the also measured, is also in line with the interest rate. Okay, so with that, I want to thank you for all the questions and all of you for staying true. and I hope to hear from you very soon. Thank you so much. Thank you, Sri, for staying through for the last 1 hour, 10 minutes. Thank you.
All right, thank you, Konhao, and thank you for being a wonderful audience. Do remember that Konhao is offering a 20% off of his trading workshop. Make more informed trades when you learn his methods. And Philip Futures is offering a $100 rebate when you learn Konhao's trading methods and open an account and trade with us. If you're already a customer and keen to enjoy the rebate and attend Konhao's workshop, please indicate your interest in the survey form after this webinar. I'll see you in our upcoming webinars. Till then, take care and stay safe. Good night, everybody.
Good night.